Now, investors are taking a pragmatic approach to the conflict in the Middle East, watching for a possible retaliation by Israel against Iran, or hoping for a ceasefire. How will the intensified conflict impact global oil prices, for example, in the short term, but the markets themselves? To help answer these and other questions, I'm joined in studio now by Maarten Ackerman, Chief Economist at Citadel. Maarten, good morning. Welcome to the South African Morning. It's really good to see you in person. We normally talk on Zoom or such. How, in your view, are investors and markets weathering this Middle East geopolitical storm?
At the moment, it's pretty much wait and see. There's a little bit of nervousness in the oil market. So this week we saw that the oil price went up. Gold, which is typically a geopolitical hedge, is also doing well. But if you think about, this has been going now for almost a year, longer than a year. And global equity markets are thriving. The gold price definitely is a reflection of that concern about geopolitics. Asian markets are doing extremely well. That's back on the Chinese stimulus early on. So it's as if the markets right now are still not really concerned about developments, but there is a nervousness, like I've said, on the oil side. And if this continue or spill over to other regions, then I do think we're in for
if more Middle Eastern countries get involved, that could, if it escalates, that could spell trouble. And for us, with oil prices, I think oil has gone up. In the first day of that missile attack by Iran,
yes,
we saw the barrel going up by $70 from $70 to $75.
Now also keep in mind that so that's a sensitivity that the market is sniffing. Iran produces about 4% of global oil, so it's not a significant supplier, but it is an important supplier. So depending on how the situation escalate, OPEC can certainly up that supply and keep the oil price intact. And they've made some of those noises as well earlier this week.
Okay, now away from geopolitical tension with the impacts that we could see in the fuel prices affecting us, when you look economically on the markets, local ones, since that interest rate cut we've seen here, but we've also seen interest rate cuts in other markets like the US. I mean, globally, how have the markets been receiving all of that news? I mean, putting the geopolitical tension aside.
Yeah, I think that's a more positive tailwind for markets. If you just take the rand as an example, after the rate cut, the rand started moving closer to 17. This week it's back to 17.50. That's again the Middle East. The rand is very much a risk indicator. So if things go well, the rand benefit extremely globally. And like this week, we gave some of that back. But definitely the rate cuts are paving the way for more liquidity. Probably consumers moving into a better space, and that's normally good for economies and markets.
Yeah, Maarten, if you would factor out the geopolitical tension, could the rand even become stronger against the US dollar in the short to medium term? What's your sense?
Yes, there's definitely a lot of tailwinds. Probably one of the strongest is the fact that the dollar is getting weaker because they're cutting rates. We cut less than the US, so we keep that bit of sweetener in terms of the yield spread. Locally, things are improving. So not only the government of national unity and the positive sentiment, but we've now got a trade surplus for 7 months in a row. So that actually means that we earn hard currency, and that's always good for the rand. We actually import less diesel because, fortunately, it seems like load shedding is being sorted out. So there's a couple of local factors that also support the rand. So yeah, there's no reason why the rand can't go in a stable global environment and test levels below 17.
Yeah, let's look at the private sector now. I mean, we see the S&P Global South Africa Purchasing Managers Index, the PMI. Has there been more growth than contraction? What are we seeing?
Yes, so that number printed this week above 50. Just to explain again, anything above 50 shows it's expanding. So that was a positive in terms of the US, especially the services component, which is sitting behind a lot of the growth in the US. The concern there is that the employment subcomponent were actually 45, well below 50. And I think that is the indication of the US economy and the job market also slowing. We'll get more data on that later this afternoon.
Okay, and then we'll see what it means. But just very briefly, Maarten, before you go, economic outlook-wise, I mean, we've had our interest rate cuts. Inflation seems to be in a decline. Yes, there's some geopolitical tensions, and everywhere else is praying and asking for a de-escalation. Economic-wise outlook, I mean, what do you see?
I think globally for the next 3 years plus, we're probably going to see capacity or even below capacity growth because the world is still slowing. Europe is really struggling to get going. South Africa, at least we've got a bit of a tailwind. There's a lot of positive sentiment. We're coming off a low base. We're addressing a lot of our structural issues. So here we're slightly more positive that in the next 3 years we could, if we're lucky, start printing numbers between 2.5% and 3% growth.
Oh, we hope that, because that could start moving the needle, even with unemployment. Who knows?
Exactly, yeah.
Thank you very much. That's Maarten Ackerman, Chief Economist at Citadel, and just giving us a sense of the economic outlook for the country, and also looking at what's been happening in the markets as the tension in the Middle East has been escalating. But let's look at some of those numbers now.